you might have a better risk-reward ratio even at a higher price. And that's something to understand. It's not always trying to buy it cheaper. It's just trying to buy it where it's more defendable position.
Okay, so for those of you just joining us, Kelly and I were talking. We thought we were live this whole time, but we weren't. Technical difficulty. My apologies. So Kelly, let's start that again. This is the we have three smart folios here that are included for free, absolutely free on the iFlip app, and we were just going to go in order from left to right. And what we were talking about is that if I click on the oldest portfolio, which is the SPY Plus portfolio, this was released with the app back in January, pre-COVID, pre-crash, when the market was still achieving all-time highs and everything was great. All the way back in January, I deposited $1,000, and right now, if we're looking at this, you would never, based on this line from January till July, the past 6 months, it doesn't visibly look like there was any crash.
Correct.
So Kelly, can you illustrate for us once again, why does it look like this? Looks great, 24% for the year on the SPY Plus. It doesn't look like there was any crash. Your comments on this, Kelly?
Again, the way our smart folios work, and as you saw briefly there, Aaron, there's three smart folios: the SPY Plus, the Red Oil, and the SPY I. They're constructed in such a way where they're managed robotically by algorithms, intelligent algorithms, learning algorithms, artificial intelligent algorithms that manage the market on an overall basis. So as you can see here, this particular SPY Plus Smart Folio consists of owning the S&P 500 SPDR, which is the proxy ETF for the SPDR.
Right.
And it also owns Apple in that ratio, 60-40. And so when you bought that back in January 22nd, there was no COVID at that time, or it was actually just a rumor, really.
Right.
At that time. The real occurrence where the market really drove down was in March. And as you can see, your portfolio did go down somewhere in the beginning of March. You can see it right there. The end of February, March. Then it started to pull back, but then the critical time of the market was in the middle of March, where the S&P 500 made its low. And if you can see on this chart, you'll notice that the Smart Folio had you literally flat. You were actually out of Apple and out of the S&P 500 SPDR simultaneously. That's the reason why the line is flat, because you had cash at that time. And even though
I'm not investing at all. I'm not.
You're not. You may have bought the Smart Folio, but the Smart Folio, being hopefully considered a smart folio, actually held you out of the market for about 9 days, from the 10th to around the 19th, I think, right?
Yes.
There, right? And so after that, it puts you back in the market. And if anybody looks at a chart of the S&P 500, you'll see that those were the 9 days where the market absolutely was destroyed. I think it was down around 7%. This portfolio was able to avoid that catastrophe. And that is fundamentally what we try to do at Flip, is give you this experience where you participate in the market when it has a reason to participate in it, i.e. it's going up.
Right.
And if it shows signals of going down, you're out. And it's the same way a person, when you go to Las Vegas, you don't always sit down and play blackjack. You do have to take a break. And it's the same thing with trading in the market. When there's times when you just really need to take a break, and the system is smarter than most people, and it took the break for you.
That is amazing. So I literally, this area right here is the difference between the S&P performance now by buying and holding, and versus investing in this smart folio, right?
Correct.
This period right here, because the S&P, if I were to have just bought and held, I would have crashed with the market that 30 something percent, and it would take so much more to break even, and then and ultimately, start making gains again. Is
Correct.
that, do I have that correct?
You have that perfectly correct.
I think
I encourage anybody to go look at the S&P 500 during the March 10th through March 19th and see what it did. And
absolutely.
I think you will find that the market didn't do well at all. And it would have been nice to say, oh, I wish I could have I wish I could have avoided that. With our smart folio, you could have.
Mm-hmm. Now, to be clear, it's not like your algorithmic intelligence understands that, what COVID is, right? It's not, it responds to the price action of the stock market as market makers do their thing, based on the news that comes out and the pandemic that unfolds.
Exactly. And I mean, it fundamentally, at Flip, we're believers that all information is formed in can be explained in the price. So price reflects, in saying it conversely, price reflects all known information in the market. The earnings to come, the analyst opinions, the dividends paid, the announcements offered by company insiders is all interpreted instantaneously in the price of any stock. Participants are literally looking at a stock in microseconds and therefore trying to make judgments of the future based on an expected earnings or a possible COVID event or a terrorist act, God forbid, is meaningless, because when they do happen, the real people that do well are the people that react fastest.
Right.
So who is the fastest to react? Well, algorithmically, you can react much faster than you could is if you were with a money manager, or you have a buy and hold strategy where you don't react at all. You just accept the fact that you're going to go through a typhoon and you hope you don't sink while you're in it. That's unacceptable. We do have a lot of information that's given to us in the market every day. The key is to be able to act on it and act on it quickly. And that's how we do it. We do it through instantaneously computer-driven algorithms and intelligence that acts on data instantaneously.
Thanks, Kelly, for that explanation. I'm absolutely so happy that this is the way that I'm investing. I do have a question for you though, because it's not just the S&P in this SPY Plus Smart Folio. It's also, you also have have Apple, and yep. Apple has been the app, I noticed, has done a little bit more activity with Apple, and this is the history over here. And we're seeing that it's done a lot more of buying and selling of Apple in the past few months. You can see March 19th right here. March 19th is where it bought the spider, the S&P, and it hasn't really done. It just bought and held. It hasn't really done anything with it. If I had continued to contribute more money, I'm sure it would have bought more. But Apple, it bought and sold a couple of different times. Can you explain why it did that with Apple?
There are multiple pieces of information that that the software uses in order to determine when to buy and when to sell. And what it's really looking at is trying to figure out when you have the best risk-reward ratio to be able to enter into a given trade. So that's why it will buy Apple or the S&P itself periodically, or sell it periodically, because risk-reward ratios are changing constantly. So on given rallies, it might sell it, try to buy it back cheaper, but if it can't, you might have a better risk-reward ratio even at a higher price. And that's something to understand. It's not always trying to buy it cheaper. It's just trying to buy it where it's more defendable position. So there is a lot of reasons why technology works the way it works, and just know that there is two components. It's not just trying to make money, it's also trying to manage risk. And that will explain why it periodically got in and out of Apple, even though Apple generally just went up from literally since the bottom of March.
Wow. You know, one thing that you said that really stands out to me is that even if the price is higher, it's possible for the risk to be lower.
Correct. Right.
Yeah. And whereas a lot of people, I think value investing, there's a lot of books out on value investing, and it's really a popular thought. And it's the idea of buy cheap, buy cheap, buy cheap. But whereas with the iFlip smart folio, the thought is, the paradigm is buy with low risk.
Think of it this way: you're not going to ever see Amazon again, very likely at $1,000 a share, right, unless it splits. So, but that doesn't mean that if I sold Amazon, for example, at 3,000, that I have to buy it at 2,800 for it to make sense. Maybe I could buy Amazon at 3,200 with better risk reward characteristics there than I would at buying it currently at 3,000. Again, awesome. It's always changing because of the information that comes into the market every day changes risk reward parameters.